Welcome to Federal Income Tax, the non-recognition lecture. So at this point, we have discussed gross income, above-the-line deductions, and a couple of the itemized deductions. With regard to gross income, we know that compensation for services are included in gross income under 61A1, and we know that gains from dealing in property are included in gross income. So we've looked at section 1001 to figure out what that gain from the dealing in property is. We know that A gives us the formula that a gain is equal to the amount realized minus the adjusted basis. Section B, 1001B, tells us what amount realized is. We know that amount realized is the fair market value of everything that you receive in exchange for the property. The adjusted basis is your adjusted basis in the property. So looking at 1001C, a little bit new for us, recognition of gain or loss. So we've been talking about realized, amount realized, gain realized. We talked about realization events when we were looking at Eisner v. McComber. What constitutes a realization event? This idea of the income being separated from the property, right? We're taxing income under Section 61 and under the constitutional amendment, but we don't have the right to tax property. So we're taxing income, we're taxing gains, and so we've got this calculation under 1001A, computation of gain or loss, amount realized, and that's going to give us our gain realized, and then 1001C tells us recognition of gain or loss. And it tells us, except as otherwise provided in the subtitle, the entire amount of the gain or loss determined under this section when the sale or exchange of property shall be recognized. To recognize it means to actually include it in gross income, or to include the loss in gross income as well. So today we're doing non-recognition. So we know that generally when we have a gain, we recognize it, we include it in gross income. But here we're looking at some provisions that tell us that even though we've realized a gain, the realization event did occur, we don't recognize the gain. These are non-recognition events. What does it mean to realize a gain but not to recognize a gain? If we realize a gain, there was a realization event, we can calculate the gain, we know how much it should have been, but we're not going to include it in gross income, at least right now. So these non-recognition provisions that you looked at for this section, mainly these ones, 1031, 1033, and 121, are provisions that say that here there was a realization event, but for policy reasons, we've decided that we're not going to recognize the income here. We are instead, and so each of these provisions, or most of these provisions, 131 and 1033 at least, give you a way to preserve that gain in the new basis that you take in the new property, so that you do eventually recognize the gain. You're just not recognizing it now. So it's a deferral provision. So 1031 is our first provision, an exchange. It's exchange of property held for productive use or investment. 1031A is our easiest type of problem, and a 1031A type problem, non-recognition of gain or loss from exchanges solely in kind. Such property is exchanged solely for property of like kind, which is to be held either for productive use in trade or business, in a trade or business, or for investment. So which is to be held either for productive use in a trade or business or for investment. So there's a couple of things in there. For a non-recognition of gain or loss from exchanges solely in kind, we need to know what in-kind property is, right? We need to know what like-kind property is. From your reading, you learned that real property has a very general, very open definition of like-kind. So we know that an apartment in the city and land in the country, real property, they're going to often be considered like-kind. Almost always they're considered like-kind property. So real property is very open, but personal property is not. Personal property is a lot more specific. We're essentially looking at things that are the same, more or less, right? So we have that first provision. We need to know that we're looking at like-kind property, and you looked at several different examples in your reading. And then our second provision, which says that the like-kind property is held either for productive use in a trade or business or for investment. So a couple of things about that second provision, that holding provision, how you hold the property. If you're looking at an exchange between two parties, and party A holds the property for productive use in a trade or business, and party B does not. They use it for, they're holding the property for personal use. And party A and party B exchange their properties. And party A uses the new property for productive use in a trade or business or for investment. Then for party A, the transaction can still be a non-recognition transaction. For party B, who's using the property for personal business, for personal reasons, for personal use, whether or not they use the new property that they received for productive use in a trade or business or for investment, because the property that they held before was for personal use, automatically they have a recognition gain. They recognize their gain here. So we look at whether the properties that are exchanged are like-kind, and then we look at each party, and we look at whether party A was using the property for productive use in a trade or business before the exchange, is using the property after the exchange, the new property for productive use in a trade or business or investment. And if both of those elements apply to party A has a non-recognition transaction. If both of those elements apply to party B has a non-recognition transaction. But just because one of the parties doesn't have a non-recognition transaction, it doesn't affect the other party. Right? So that's the easy one. A non-recognition of gain or loss from exchanges solely in kind. B is gain from exchanges not solely in kind. So with B we're looking at gain, C we're looking at loss from exchanges not solely in kind. So if an exchange is not solely in kind, that means that if two parties exchange property and the property is like-kind property, but one of the parties or both of the parties tosses in something extra, the exchange is not solely in kind. So oftentimes, if you have like-kind property, the like-kind property might not be worth the same amount. So if I have a property worth $500,000 and somebody else has a property worth $300,000, perhaps we exchange our like-kind properties, but then because their property was only worth $300,000, I want them to give me $200 additionally in either cash or property. So that extra amount, that $200 in cash or property, we call that boot. So that's boot that we add on. So we have like-kind property, and then any non-like-kind property in the transaction is boot. So boot doesn't get that non-recognition provision. So in a non-recognition transaction that's an A type, where it's solely in kind, I'm exchanging a property worth $500,000 for your property worth $500,000. We just switch properties and there's nothing addition thrown in. It's pretty simple. We both keep our original basis. So if I have a property worth $500,000 with a $100,000 basis, and you have a property worth $500,000 with a $300,000 basis, you take my property with a $300,000 basis. You keep your same property. And I take your property with a $100,000 basis. I keep my same basis. So then even though we have this realization event where we're switching properties, we're not recognizing that gain now. Because I'm keeping my same low basis, when I sell the property later at some point in the future to anyone, I'll recognize that gain then. So this just allows us to defer the gain. We're deferring the gain till some later point when you're exchanging it for non-like-kind property. So when we're talking about B and C type transactions, gains from exchanges not solely in kind, and losses from exchanges not solely in kind, then we're switching properties and we're throwing in something else, that boot that we mentioned before. So if we're throwing in something else, we're going to need to recognize some gain. We're going to recognize gain to the extent of the other property received, the extent of the fair market value of the other property received. If we have an exchange not solely in kind, and we would other recognize loss on the property on the exchange, you can't recognize the loss from the exchange. So our next provision, 1031D, is going to tell us, 1031D is going to give us our basis, right? So the first basis rule I already mentioned, if the property was acquired on an exchange described in this section, then the basis shall be the same as the basis of the property exchanged, decreased in the amount of money of any property received by the taxpayer, and increased in the amount of gain or decreased in the amount of loss to the taxpayer that was recognized on such exchange. So if we're talking about switching like-kind properties, that A-type transaction, then there's no other property involved, so we keep our own basis. If we're talking about a B-type transaction or a C-type transaction, then we have to apply this formula in 1031D. Let's go back. Okay. So we know 1031, we're talking about exchange of like-kind property, and we're talking about property held for productive use in a trade or business or for investment purposes. It's also good to note now that if I am holding property for use in a trade or business, and it's like-kind property, and I exchange it for like-kind property, and the new property I hold for investment purposes, that's okay too. That still comes under the non-recognition provision. I don't have to hold it for productive use in a trade or business, both before and after. It's either or. But I do have to hold it for either productive use in a trade or business or for investment, both before and after the transaction, or I don't get the non-recognition provision. What happens if I don't get the non-recognition provision? Then I have to recognize that gain that I've realized. How do we know how much gain I've realized? We use our formula under 1001A. Amount realized minus adjusted basis equals gain. A negative number would then give us a loss. All right, so in A2, so 1031A2, there's an exception. So we're talking about like-kind property. We're trying to figure out if something's like-kind. There are a couple of things that are listed that are not like-kind. So these are specifically enumerated exceptions for like-kind property. This subsection shall not apply to any exchange of stock and trade or other property held primarily for sale. So you can't have like-kind property that's held primarily for sale. So inventory cannot be like-kind property. Stock and trade as well, that would be a securities type dealer. B, stocks, bonds, and notes. So we know that stocks are never like-kind property. Other securities are evidence of indebtedness or interest in a partnership, certificates of trust or beneficial interest, or truces in action. So we have a couple of things that all came up because there were cases related to these elements and they were added into the code. So we know that if we're looking at stock, we're never looking at like-kind property. All right. So next, Harry is exchanging a tractor that he uses in business for Sally's office furniture, which she uses in her business. Both Harry and Sally will use their newly acquired property in their businesses. So read through 1 through 4 and figure out which one is the correct answer. So in this case, we have to look to see if we have a like-kind transaction, a non-recognition transaction. So do we have property that is like-kind, and are both Harry and Sally using the property both before and after for trade or business purposes or use or investment? So our first question is, we know that when we're talking about personal property, right, not real property. So here we have personal property. A tractor and office furniture are personal property. We know when we're talking about personal property, we read that we're looking at the specific class that it would fall in. And a tractor and office furniture are not going to fall into the same class, the same asset class. So here we don't have like-kind property. Because we don't have like-kind property, this is not a like-kind exchange for either Harry or Sally, and both must recognize gain on the exchange. Our next question. Harry is exchanging a parcel of undeveloped land that he held for investment purposes for a building that Sally owns in the city, which she lives in with her children. Harry will rent out the new property. Okay. So read through the answers again and figure out which one applies here. So first we have to determine if there's like-kind property, and then we have to determine the holding requirement, right? Are they holding it for business or investment purposes, productive use in a trade or business or investment purposes, both before and after the transaction? So we have to look at them individually. So first, looking at like-kind, we have a parcel of undeveloped land and a building in the city. So is a parcel of undeveloped land and a building in the city like-kind property? We know that these are both real property. We've read that real property, we have a very, very open definition of like-kind when it comes to real property. So we've satisfied the like-kind requirement. Now we have to figure out if we're satisfying the holding requirement. So does Harry satisfy the holding requirement? Is he holding the property for productive use in a trade or business? Or is he using it for investment purposes, both before and after the transaction? So Harry is exchanging a parcel of land that he held for investment purposes. Okay, so before we're all set with investment purposes. Looking at after. After, he's exchanging it for a building in the city, and he'll rent out the new property. So it seems that after the transaction, he will use the property for productive use in a trade or business. So from Harry's point of view, he satisfied both the like-kind and the holding requirement, and therefore non-recognition applies as to Harry. Then we have to look at Sally. We've already covered the like-kind issue. Sally also is exchanging like-kind property for like-kind property. So we have to look at Sally's holding requirement and whether she satisfies her holding requirement. Sally is exchanging a building that she owns in the city in which she lives with her children for a parcel of undeveloped land in, we don't know if it's in the country, but undeveloped land. So we know that before the transaction, the property that Sally is exchanging is personal use property. It doesn't seem to be held as investment property. It doesn't seem to be held for productive use in a trade or business. So right there, we know that Sally fails the holding requirement of the non-recognition provision, and non-recognition will not apply to Sally. So here we have a situation where Harry is able to use the non-recognition provision, but Sally will not. So Sally will recognize gain or loss. Harry will be able to defer the recognition of gain, not recognize loss, and he'll be able to recognize that in the future. All right, so 1031 type problem, we know that an A-type problem is the exchange of like-kind property for like-kind property, solely like-kind property. There's no extra thrown in, there's no money thrown in, there's no boot thrown in. So 1031A problem, Bob has real property held for productive use or investment with an adjusted basis of $10,000 and a fair market value of $100,000. He exchanges his real property with Mary for Mary's real property held for productive use or investment, which she holds with an adjusted basis of $70,000 and which has a fair market value of $100,000. So with regard to each of them, we would normally calculate the amount realized as as the fair market value of everything received. We would calculate gain realized as amount realized minus adjusted basis, and then we would figure out how much we have to recognize. We know that in a 1031A problem, as long as it's like-kind property for like-kind property, it's solely in exchange for like-kind property, and therefore we have non-recognition. So Bob has this real property that he's holding for productive use or investment, and he exchanges it for real property held for productive use or investment. And we're going to assume that after the exchange, they're both going to be holding the property still for productive use or investment. Therefore, they're satisfying the holding requirement, and because they're exchanging real property for real property, and we have a very wide definition of like-kind property with regard to real property, they're also satisfying the like-kind requirement. So what happens? Okay, Bob had an adjusted basis of $10,000 and a fair market value of $100,000 in his property. Mary had an adjusted basis of $70,000 and a fair market value of $100,000 in her property. I can't write on this. So Bob will take Mary's property and Mary will take Bob's property, and they'll both retain their original amount realized. So Bob will take Mary's property and have an adjusted basis. Bob will take Mary's property and he will have an adjusted basis in Mary's property of $10,000. Mary will take Bob's property and have an adjusted basis in Bob's property of $70,000. So they're switching properties, but they're retaining their original basis in the property. And what does that allow us to do? It allows us to defer the gain, to not exclude the gain, but to defer it. So tomorrow, if Mary sells Bob's property for $100,000, she will have a gain recognized, assume she's not exchanging it in a like-kind transaction, of $30,000, because she'll have a $70,000 basis in Bob's property. Bob has $90,000 now of unrecognized gain in Mary's property that he holds. So Bob's holding Mary's property, which is worth $100,000. Bob has a basis of $10,000 in that property. There's $90,000 of unrealized gain, unrecognized gain there. If Bob sells it tomorrow for $100,000, he'll have $90,000 worth of gain. So we're just deferring recognition in a 1031 type problem. All right, so we talked about the holding requirement. We know that you have to hold the property both before and after the transaction for productive use in a trade or business or for investment. We know the difference between gain realized and gain recognized. Gain realized is AR minus AB. 1031A tells us that gain realized is amount realized minus adjusted basis. 1001C tells us that generally if we realize gain, we recognize gain. So the difference between gain realized and gain recognized, generally there isn't one. Generally anything realized is going to be recognized. The difference occurs only in these types of non-recognition transactions. So if you look at 1001C, it says that gain realized is recognized unless there's a provision that says otherwise, right? So these are provisions that say otherwise. So in these types of problems and non-recognition problems, we do have to determine what the gain realized is, and then we determine what the gain recognized is. And we know these might not be the same thing. So what is boot in a like-kind transaction? Boot is anything in the transaction that's not like-kind property. So if we exchange real property for real property, and one party throws in 10 chocolate bars and the other party throws in a motorcycle, the two pieces of real property are like-kind property, but the motorcycle and chocolate bars are not. They are boot. So anything that's not part of the like-kind transaction, the like-kind property, is boot. There are two types of boot. You have cash boot and property boot. So in the example I just gave, the chocolate bars and the motorcycle are property boot. If we also threw in $10,000, that would be cash boot. All right, gain recognized basis in new property. So 1031D is going to give us the basis in the new property. So this calculation for basis in the new property is what allows us to defer the gain instead of just never recognizing the gain. So what do we have here? All right. So in a non-recognition transaction, the reason why we're looking at like-kind transactions and allowing for this non-recognition provision to property exchange that we consider like-kind, we're looking for that continuity of interest, right? So when we looked at Eisner v. Macomber, we were looking at the stock dividends, right? And so in the stock dividend, we said the stock dividend, it was still the same property. You were just getting more stock for the same for the same stock you already received. So there was no conversion into cash. There was no conversion into the income portion. With this like-kind property transaction, with these non-recognition transactions, we generally have the same continuity of interest. We have property that's like the other property, so it's the same character of property. So you're exchanging property for property that's of the same character. So it considers that property that you're receiving in exchange as a continuation of the investment that you made in that original property, but in a modified form. Since the investment is in substance a continuing one, the taxpayer has only technically but not effectively realized gain or loss, and the exchange is regarded as an inappropriate time to levy a tax or to permit a deduction. All right, so the holding requirements. All right, so our basis. Our basis allows for that deferral of income. So whatever gain that we didn't recognize on that transaction, right? So we would have realized it but not recognized it due to the non-recognition provision. Whatever gain we didn't recognize in the non-recognition transaction, we're going to preserve it in the new basis. Right, so 1031D provides for a basis calculation in a non-recognition transaction. It's considered an exchange basis. So we saw in 1012 a cost basis, in 1011 the adjusted basis, 1014 which we're doing or have done, a stepped up basis acquired from a decedent when property is acquired from a decedent. 1015 we have gift basis. So here in 1031, this basis here, it's an exchange basis. So how do you determine what your exchange basis is in a non-recognition transaction? You calculate it by starting with the basis of the property exchanged, so your old basis. So the property that you held at the beginning of the transaction, you start there and you decrease that, so subtract out the amount of money received by the taxpayer. Then you increase that, so you add into that the amount of gain. So you increase it by the amount of gain, or you decrease it by the amount of loss recognized by the taxpayer. So we know in a 1031B type transaction, we can recognize gain if there was boot involved, to the extent of the boot. We did see in 1031C that you don't recognize loss on a like-kind transaction. Well, it's true that you don't recognize loss with regard to the like-kind property. You can recognize loss with regard to the boot. All right, the base of the requirement. All right, so we're going to do some problems. The problems start on page 282. And we have problem 4. Marie holds Blackacre and Fred holds Whiteacre. The fair market value of Blackacre is $500. The adjusted basis of Blackacre is $200. Fred holds Whiteacre, and the fair market value is $480. The adjusted basis is $450, and Fred is also paying in $20 of cash. Because Fred's property that he's exchanging is worth less than Marie's property, Fred's going to toss in some cash to even up the deal. So first we figure out the gain realized. So in problem 4, Marie has realized a gain of $300. How do you determine gain realized? It's the 1001A equation, amount realized minus adjusted basis. So what is Marie's amount realized? She has realized the fair market value of everything she received. She received Fred's property of Whiteacre, which was worth $480, and she received $20 of cash. So her amount realized is $500, and her adjusted basis is the adjusted basis in the property that she gave up, $200, which gives her a realized gain of $300. So recognized gain, how much do we recognize? So we know that this is a 1031B type problem. It's an exchange not solely in kind. So what happens when there's an exchange not solely in kind? We know that you recognize gain to the extent of boot received. So in this case, Marie has received $20 worth of cash boot. So she's received $20 worth of boot. So while she had $300 of realized gain, she only recognizes gain to the extent of the boot received. So in this case, the boot received was $20, so she's only going to recognize $20 worth of that gain that she realized. New basis in Whiteacre. So what is her new basis in Whiteacre? Her new basis in Whiteacre is her old basis, which was $200, her old basis in Blackacre, decreased by the cash that she received, and then increased by gain recognized. So in this case, she received $20 worth of cash, she recognized $20 worth of gain, and they cancel each other out. They won't always cancel each other out. In the case where the boot received is less than the gain realized, then you are recognizing the entire amount of the boot. So in that case, they will cancel each other out. But we'll see another problem soon where they don't. So you still should go through the basis calculation. So in this problem, Marie had $280 of unrecognized gain on the exchange, $300 of gain realized minus $20 gain recognized, and the new basis produces $280 of built-in gain in the new property. The $480 fair market value minus the $200 basis that we calculated from 1031D. Alright, a breather. Next problem. I'm missing a page. I'm going to pause this. Okay, so now we're looking at problem 5. Problem 5, Marie owns Blackacre, Fred owns Whiteacre. Marie has a fair market value of $500 in Blackacre, an adjusted basis in Blackacre of $200. Fred has $480 in Blackacre, $480 fair market value of Whiteacre, an adjusted basis of $450 in Whiteacre. So now we're looking at Fred, right? So it's the same situation, but now we're looking at Fred. So what's the big difference between Fred and Marie in this situation? Both had built-in gain, right? Both had an adjusted basis that was less than the fair market value of the property they were exchanging. But Marie, when we're looking at it from Marie's standpoint, Marie was receiving boot. Fred is not receiving boot, he's giving up boot. So when we're looking at it from Fred's stance, he's not going to recognize gain. He essentially has a 1031A type problem. He's exchanging for property solely like-kind property. Okay. So Fred's gain, he had a fair market value of 480 in the like-kind property. His adjusted basis in his property was 450. So when we figure out realized gain, we come up with $30, right? 480 minus 450, AR minus AB. But what about when we're talking about recognized gain? If we're in 1031B, we say that gain's recognized to the extent of boot received. But Fred didn't receive any boot here. Fred gave up boot, Marie got the boot. So Fred is not recognizing any gain. So how do we figure out Fred's new basis, right? So what do we start with? We start with old basis, right? Original basis. Now here's the key highlighted point here. When we're talking about Fred's old basis, we're talking about Fred's old bases. Fred gave up two things in this transaction. He gave up property worth 480 and he gave up cash worth 20. Cash always has a basis equal to its face value, right? $20 of cash, fair market value $20, basis of $20. You can never have a basis in cash less than its face value. Okay, so we start with adjusted bases and everything that Fred gave up. So 450 for the like-kind property for Whiteacre and 20 for the cash. So Fred's original adjusted basis in the property that he gave up, or his bases in the property that he gave up, is the 450 in Whiteacre and the $20 of the cash. Okay. So you can see this was written out if you looked at Treas Reg 1.1030D-1A. So the 1, we know we're in income taxes with Treas Regs. The 1031 tells us we're in section 1031, which is what we're doing here with non-recognition. 1.1031D, the D tells us what subsection we're applying to. So we're looking at the -1A Treas Reg for 1031D, right? If you look at that Treas Reg, it explains to you, it shows you that cash is also included in this original basis when you're doing this 1031D calculation. Alright, so we know that we start with original basis, or bases and property given up. So we have the 450 in Whiteacre and the 20 in the cash that he gave up. So we have 470. We know that he had $30 of unrecognized gain on the exchange, and the new basis produces $30 of built-in gain in the new property. So 500 for market value and a 470 basis. So Fred's new basis in Marie's property Blackacre that he holds is going to be that 450. The basis in Whiteacre plus the basis in the cash. And his fair market value of the property, it's that 500, we know the fair market value. So he has a $30 built-in gain. We know that his realized gain on the transaction that he didn't recognize was also $30. So we know we've done the problem right. We know we've taken that realized gain that was not recognized because he didn't receive boot, and we've preserved that unrealized gain, right? Or that unrecognized gain. We've preserved that unrecognized gain in Fred's new basis. So Fred's new basis in Blackacre is $470. Alright, super clear, right? So now we're on to problem 6 in Chloe and Flora and Greenacre and Blueacre. Alright, so we know that Chloe has a fair market value of $200 in Greenacre, an adjusted basis of $230. So now we're looking at a problem where there's a built-in loss here. We know that Flora owns Blueacre, has a fair market value of $150. We know that there's going to be an exchange here, and because Flora's property is less than Chloe's property, Flora's going to throw in $50 of cash boot to even things out. We aren't given Flora's adjusted basis here because we're only asked for the ramifications to Chloe in the transaction. So we don't need Flora's adjusted basis. So there's an exchange of these two properties and we look at Chloe. So we know this isn't a 1031A type problem. In a 1031A, it's solely like kind, and we know Chloe's receiving cash here. Is this a 1031B type problem where there's an exchange for property not solely in kind, and there's a gain? We know we're not there because we have a built-in loss, and so we're in C. So 1031C. All right. So Chloe realizes a loss here. She had an adjusted basis of 230 and a fair market value of 200 when she makes the exchange. She has a realized loss of $30 when we do our AR minus AB. We get 200 minus 230, which gives us a negative 30. So we know we have a realized loss of 30. But she doesn't get to recognize that loss. Pursuant to 1031C, it says you don't recognize the loss. Okay. So what is her new basis? So we look to 1031D and it tells us to start with her old basis. So we start with her basis in Greenacre. She had a 230 basis in Greenacre. Alright, so we start with her basis in Greenacre. We decrease it by cash received. So 230 minus the $50 that she received from Flora gives her a basis of 180. She had $30 of unrecognized loss on the exchange, and the new basis produces $30 of built-in loss and the new property. The 150 fair market value minus the 180 basis. So Chloe has taken Blue Acre, and she has a $180 basis in Blue Acre. The fair market value of Blue Acre is $150. So she's preserved that $30 worth of loss in the basis of her new property. All right, on to Mark and Sophie. Take a breather for a minute. Okay. So here we're looking at Red Acre and Brown Acre. We know that Sophie owns Red Acre. Red Acre has a fair market value of $400, an adjusted basis of $380. Mark owns Brown Acre. Mark's Brown Acre has a fair market value of $370. Because that's $30 less than the fair market value of Sophie's property, Mark's going to kick in an extra $30 worth of cash boot to even up the transaction. We don't know Mark's adjusted basis. We don't need it because we're only concerned about Sophie here. So our first step is always to figure out Sophie's realized gain. To figure out realized gain, we do AR minus AB. AR, the fair market value of everything that Sophie receives here, is $400. The adjusted basis of the property that Sophie gave up is $380. So Sophie has a realized gain of $20. So then we ask about recognized gain. So 1031B tells us your recognized gain is the realized gain to the extent, you recognize boot to the extent of gain realized, right? So here we figured out she had a realized gain of $20. She receives $30 worth of boot. Here, her boot is greater than her realized gain. Because her boot is greater than her realized gain, that means that we're limiting her recognized gain to her realized gain. Right? So we started out with realized gain here. We did the 400 minus 300. I feel like I need to redo that one. Alright. We figured out Sophie's realized gain. Her realized gain was her amount realized minus her adjusted basis. So we had a realized gain of $20. Her boot received was $30. We can never recognize more than we realized. So here Sophie realized $20. Because her boot is $30, it's greater than her realized gain. Her recognized gain is limited to her realized gain. So in this case, even though Sophie's boot received was $30, she's only recognizing $20. So this is going to be a situation where the 1031D basis calculation will not cancel out. Those 2 second elements, cash received and gain recognized, they won't cancel each other out. All right. So you have to figure out now Sophie's new basis in Brownacre. In order to do that, we start with her original basis or bases and property given up. Here, the only thing that Sophie gave up was Redacre. Her basis in Redacre was $380. So you start with original basis, you decrease that by cash received. Here she received $30 worth of cash. So 380 minus 30. And then you increase that by $20 of gain recognized. So 380 minus 380 minus 30 plus 20. She had no unrecognized gain on the exchange, and the new basis produces 0 built-in gain in the new property. In the new property, it's a $370 fair market value. She has a $370 basis, so if she goes out and sells the property tomorrow, she'll have no gain on the property. She recognized it all in the non-recognition transaction, despite it being a non-recognition transaction. Okay. So the next element that we look at, the next code section, is our involuntary conversion section. So our non-recognition sections, they were this earlier idea that you're continuing your interest in the same property. And so if you're continuing your interest in the same type of property or investment, and we're holding it much more open to real property, that we're not going to make you recognize gains right now. We're going to let you to continue that property interest. We decided it was better for the economy, it was better for the same type of property to move freely throughout society, that people aren't deterred by this penalty, essentially, of having to recognize gain when you engage in a transaction. 1033 is a little bit different. In 1033, we're talking about involuntary conversions. So if we have an involuntary conversion, it's certainly not a provision that encourages people to engage in a certain behavior. If it's an involuntary conversion, the taxpayer involved didn't make a choice, hopefully. Hopefully he wasn't burning his own stuff down, right? Hopefully he didn't make a choice. He didn't have any say in the transaction happening, in the disposition of his property occurring. So if the property, as a result of its destruction, in whole or in part, theft, seizure, or requisition or condemnation, or threat or imminence thereof, is compulsorily or involuntarily converted, right? So with an involuntary conversion, if it's involuntarily converted, we don't recognize gain in certain instances. So if the taxpayer during the period specified in some paragraph B, for the purpose of replacing the property so converted, purchases other property similar or related in service or use to the property so converted. So those are important words. Property similar or related in service or use to the property so converted, the gain shall be recognized only to the extent the amount realized upon such conversion exceeds the cost of such other property or such stock. So what are we doing there? Essentially, when your property is involuntarily converted, oftentimes you're receiving, insurance money, right? So if you had a house worth $500,000 and it burns down, it wasn't your fault, or at least they haven't figured it out yet. You get $500,000 from the insurance company, and you can choose to do what you wish with it. So if you choose to go ahead and you choose to purchase a house similar or related in service to the property that was converted, then we're not going to recognize any gain. So if you had a house worth $500,000 and you had an adjusted basis in that house of $100,000, essentially when the insurance company is giving you the $500,000, you would normally have to recognize that gain, right? You had a piece of property with an adjusted basis of $100,000, a fair market value of $500,000, and your insurance company is giving you $500,000 for the property. You had a $400,000 built-in gain there. And you have a realization event. You've just been handed $500,000 in cash. So it would normally make sense that you would have to recognize that gain that was built into the property, right? That difference between your basis and the value of that check that you just received, that $400,000. But if you fall under 1033 involuntary conversions, this provision allows that if you reinvest that money, if you take that $500,000 and you reinvest it into property that's similar or related in service or use to the property that if it was burned down, in this case, that house, then you only recognize gain to the extent the amount realized exceeds the cost of such other property or such stock. Okay, so what does that mean? That last bit? So that last bit says that if my hypothetical $500,000 house that burned down had an adjusted basis in that house worth $100,000, or an adjusted basis of $100,000, I had $400,000 of built-in gain for my house, right? So if I take that $500,000 check from my insurance company and I go out and I buy another house worth $500,000, then I'm all set. I don't have any gain. I don't have to recognize any of that $400,000 of gain. But if I go out and buy a new house that's only worth $480,000 instead of that $500,000, and I pocket $20,000 worth of cash, it says the gain shall be recognized. So I look at my gain realized. My gain realized was $400,000. That unrealized gain, right? Was realized at the time of the disposition or the payment check from the insurance company. So that $400,000 of gain, I'm only recognizing it to the extent that the amount realized, that $500,000, exceeds the cost of the other property that I purchased. I purchased that other property for $480,000. So the amount that the insurance company gave me exceeds the cost of my new property by $20,000. So I will recognize gain to the extent of that $20,000. Does that mean I necessarily recognize $20,000? In this case, yes. In this case, I had $400,000 of gain that I could recognize. So I have at least $20,000 worth of gain that I can recognize, so I've recognized $20,000 of gain. Now, what if I had a property, my same $500,000 house? What if I had an adjusted basis in that property of $490,000, right? If I had an adjusted basis of $490,000, had a fair market value of $500,000, I only had $10,000 of gain in there. The insurance company gives me a check for $500,000. I go and reinvest it into a house that caught a similar or related in service or use property, and the new property that I purchased with it is what is it? It's $480,000, right? So in that case, the difference between what the insurance company gave me, the amount that I received upon the conversion, exceeds the cost of the other property, right? It exceeds it by $20,000. However, I can only recognize gain to the extent that I have gain to recognize. So because my property had an adjusted basis of $490,000 and a fair market value of $500,000, and my amount realized, right, the fair market value of what I received was $500,000, there was only $10,000 of gain in there. So even though my new property was $20,000 less than the amount that I realized upon such conversion, so $20,000 less than that $500,000, I can only recognize 10,000. That difference, that gain, right? That gain that was in there. So my adjusted basis was 490. My original house was 500. I only had 10,000 of gain in there. So when it burned down and the insurance company gave me the money, I might have had to recognize $10,000, but that's all I would have had to recognize in a normal, straightforward gain calculation. Because of 1033, it says that, if I reinvest this money into a new property, similar or related in service or use to my old property, I can defer gain, right? I can include it in my new basis. But if I'm buying new property with a fair market value that's less than my adjusted basis and my property that burned down in this case, then I'm not benefiting at all from this 1033 involuntary conversion provision. Basis of property acquired through involuntary conversion. So this is the same as the 1031D type basis. It's stated as a different calculation, but we're doing the same thing. We're taking any amount that we didn't recognize due to the non-recognition provision, right? Any amount of gain realized that we didn't recognize, and we're preserving it in the new basis, right? The basis of the new property that we hold after the conversion. So the basis of property acquired through involuntary conversion is the old basis minus money received, which was not used. Decreased in the amount of any money received by the taxpayer, which was not, essentially reinvested, and increased by the amount of gain or decreased by the amount of loss to the taxpayer recognized. So in the situation where my original property was had an adjusted basis of 100, and I received this $500,000 check from the insurance company, right? There was $400,000 worth of gain in there. So if I buy a new property for $500,000, I take that new property with a $100,000 basis. I get to defer all of it. But if I buy a new property worth $480,000, I'm going to have to recognize $20,000, which means I get to add that, like anything I'm recognizing, that becomes more investment into the property. So I recognize that $20,000 and I include that in my new basis as well. Alright, so that's involuntary conversions. What do we have? We have problem 8. I think I mentioned the general time limit for reinvestment for involuntary conversions is 2 years from the end of the year in which you realize the gain. So it's generally a 2-year period. I'm not going to test you, on specific calculations of that. I'll give you something like within a year or something like that, where it's clearly under the 2-year period. But know that in practice, you're going to have to figure out if it's within this period of time. You're going to have to go through the calculation. Alright, so on page 284, problem 8, we're looking at Carl. And Carl had a piece of property with a fair market value of $600,000 and an adjusted basis in that property of $250,000. And the property is involuntarily converted. When it's involuntarily converted, Carl has a realized gain of $350,000, right? The 600 minus the 250. So he has a realized gain of $350,000. But we know 1033 applies, and it's a non-recognition because Carl invests the money received in a new piece of property. So he purchases this new piece of property worth $560,000. All right, so he had received $600,000 from the involuntary conversion. And the reinvestment, the cost of the new property was only $560,000, right? So how much does he recognize? He recognizes the gain realized to the extent that the amount that he received from the property converted exceeds the cost of the new property. So he received $600,000, and his new property, the cost of his new property is $560,000. So he's going to recognize that difference, that $40,000, to the extent that he can. So the amount recognized, the most he can recognize here is $40,000. So as long as the gain realized is greater than or equal to $40,000, he's going to recognize $40,000. Here, because the gain was $350,000, he's going to recognize all $40,000 of that. So 1033A2A, 1033A2A tells us recognize only to the extent that the amount received exceeds the cost of the other property. So remember, that exceeds the cost of the other property. All right, so now we get to figure out his new basis. So how do we figure out his new basis? So this is a little bit complicated. I might say it twice. So new basis, figuring out new basis. So we start with cost, right? So what was the cost of the new property? The cost was $560,000. We reduced that by the gain realized but not recognized, right? So what was his gain realized? His gain realized was $350,000. His gain recognized was $40,000. So how much of his gain realized was not recognized? So that difference. So again, we start with the $560,000 cost, and we're going to reduce it by the $310,000 of gain realized but not recognized. And then 350 minus 40, and so we end up with $250,000. So Carl's new basis and that new property that he holds is $250,000. So there was a bit of a red herring in the problem. They did talk about this $160,000 of cash in Carl's pocket at the end, right? Because he's taking out, this loan amount, right? It does not trigger recognition of gain because it's attributable to Carl's borrowing rather to a difference between the amount realized and the replacement cost here. So it's not important, right? Carl could have taken his old property. His old property had a fair market value of $600,000 and an adjusted basis of $250,000 when we started the problem. So if his property wasn't involuntarily converted, he probably could have taken a second mortgage out on it or refinanced his mortgage and increased it, right? If he had an adjusted basis of $250,000, there's a lot of gain in there. So if his mortgage was significantly lower, presumably it was, then he could have refinanced it. And so we're not going to penalize him here. So we knew before when we looked at, what did we look at? With the related party, not the related party, in the installment sales. When we're looking at the installment sales, if you took out a mortgage in anticipation of the sale of the property, we didn't count it as qualified indebtedness. But here it's fine, and it's mostly fine because it's an involuntary conversion. And so we don't want to penalize Carl because his property was involuntarily converted. It's not his fault that this terrible thing had happened. So we're going to want to put him in the same place as he was before the incident and allow him to take out, to borrow against the property. All right. What else do we have? All right, so in problem 9, we're talking about condemnation of real property not held for productive use or investment. So if your house burns down, right? And we had, for if your house burns down, if it's personal use, we had a similar or related in service or use standard. So if my house burns down, I can't buy an office building with it. I have to buy something similar or related in service or use. So presumably, if I lived in my house, I have to buy something I can live in. So similar or related in service or use. It seems like if my house burns down, I can buy a condo with that money, right? Similar or related in service or use. In 1033G, we talk about property held for productive use in a trade or business or for investment. And so with that type of property, it's not as strict. It's not similar or related in service or use. Instead, we use a general like-kind standard, right? So it's that same kind of standard that we saw in 1031. So if we have property held for productive use or in a trade or business or for investment, and we have an involuntary conversion, we look at 1033G1 and we use the like-kind standard for property allowed to replace it. So what kind of property can replace? So now I have an office building that I rent out to people and I'm using it for productive use in a trade or business. And since we're moving to the like-kind standard of 1031, now I can go out and buy a farm for investment purposes or a parcel of land, right? Because if we're using the real property, we have this very open like-kind standard. So like-kind, much more general than similar or related in service or use. All right, so our last provision that we're looking at is 121. All right, so with 121, we're looking at exclusion of gain on sale of a residence. So this is another exception to 1001C. 1001C was that provision that told us if we realize gain, we recognize it unless something says otherwise. 121 says otherwise. So if you have a personal residence and you sell your personal residence, you exclude from gross income gain to the extent of $250,000 for an unmarried individual or for an individual, and $500,000 for a married couple filing a joint return. So if you have an adjusted basis in your property of $200,000 and you sell it for $1 million, you have $800,000 worth of gain there, right? So if I'm unmarried, I exclude from gross income $250,000 of that, right? So that $800,000 minus $250 gives us $550. So I would only include $550 of gain in there. If I'm married, right, if I'm a married individual, that same property, that $800,000 of gain, I get to exclude $500,000 of it from my gross income, right? So I would only include $300,000. So 121 falls between 101 and 140, so we know that we have an exclusion from gross income provision. All right, so how do we know that we can take this exclusion of gain on the sale of a personal residence? We have a couple of tests that we have to apply. The first is an ownership test. The taxpayer must have owned the residence for a total period of 2 years in the 5-year period prior to the date of such sale. Okay, so you own it for 2 years in 5 years. Okay, use test. Taxpayer must have used the residence as his personal or principal residence for a total period of 2 years in the 5-year period prior to the date of the sale. So it has to be your principal residence for 2 years in a 5-year period. So essentially this stuff is stopping people from flipping houses. You at least have to hold the property for 2 years before you can make such a flip. And then our next provision is once every 2-year test. You cannot have made prior use of the 121 exclusion within the 2-year period prior to the date of sale. All right, we've got our 3 tests. So 121B2A talks about married individuals filing a joint return. So we know that for an unmarried individual that satisfies the test, they can exclude $250 of gain. For married individuals filing a joint return, they can exclude $500 of gain. There is a little bit of parsing of that for there's a married couple, and one of the individuals has already, has used it once, will violate the once in 2 years test, or, hasn't used it for 2 out of the last 5, or primary resident for 2 of the last 5. So they can only take that 500 amount if either, If either spouse meets the ownership requirements, both spouses have to meet the use requirement, and neither spouse is ineligible for the benefits because he or she took the benefit within the past 2 years. So what they do is they say that if you as a married couple filing a joint return, if you satisfy these provisions under 121 B2A, if you satisfy those 3 provisions that I just mentioned, you can use the $500,000 exclusion. If you don't satisfy them, if only one spouse satisfies them, you can still use the $250,000. You're not completely disqualified for using any of it. Alright, what else do we have? Alright, so there's another provision under 121C. There's special rules in cases where the sale or exchange does not meet the 2-year ownership test and use test because of change in place of employment, health, or to the extent provided in the regs, unforeseen circumstances. So it's Treasury Reg 1.121-3, and so if these elements apply, we can prorate. So we've got you have to have used the residence as your principal residence for a period of 2 years in the 5 years. You have to have owned it for 2 years out of the prior 5 years. So if you've only owned it, say, for 1 year, and one of these special provisions apply to you. So one is that your job moves. Like if your place of employment moves, more than X amount of miles from your old place of employment, so you're essentially forced to move, they allow you to prorate it. So if you live there for a year and you're unmarried, you would get $125,000 exclusion instead of the $250,000 exclusion. Tends not to be such an issue lately with property prices. Alright, anything else interesting? Deceased spouses, recently deceased spouses. If an unmarried individual sells a home and the spouse is deceased on the date of such sale and the sale occurs no later than 2 years after the date of the death of such spouse, $500,000 shall substitute for $250,000. So if your spouse dies, you can sell it quickly and you can still take the $500,000. So that's it. Not too bad, right? So you have that gains from dealing in property handout, which I think it is a fantastic job of going through this material. That handout, it also goes as far as liabilities, and the exchange of properties with liabilities and how to treat liabilities, so assumption of mortgages. I think it's interesting to read. I think it's worth a read through and trying to figure out how it all works. I won't test you on it. It will not be tested on the quiz. It won't be tested on the final. Everything before liabilities is fair game for the final. So that handout does go into other like boot, like a property boot and cash boot. It has both of them included. So I think that's a great. Here's our 121 exclusion of gain on the sale of a principal residence. You have your 3 test ownership use and once every 2-year test. But that's property transactions. So if you take the time and you move through it, you try to master it. Again, like the point isn't that you know how to do all the math. The point's that you understand what's going on, right? And you demonstrate that you understand what's going on by doing all the math. So I guess it works out. But the point is that you're essentially preserving your investment in the same piece of property. And if you're preserving your investment in that same piece of property, that like-kind property that the IRS has determined, right, this certain type of property, this that falls under 1031 and then in 1033 and in 121, they've just carved out certain types of property that you can exchange or otherwise dispose of, and they're not going to make you recognize the gain right then. So you're looking at different questions when you have a non-recognition transaction. First you have to make sure it satisfies it. So 1031, you have to look at whether it is like-kind property. And then you have to look at the holding requirement. For 1033, you have to look at whether it satisfies the involuntary conversion definition. You have to look at whether you've replaced the property within the time period allotted, generally, 2 years. And then you look at, and with involuntarily converted, you also look at the cost of the new property. So you're looking at whether these provisions apply to give you this benefit of deferring your gain to a later time. And then the last thing you have to do in each of these transactions is to figure out your basis in your new property. So in a like-kind transaction, whatever property you hold at the end. So it's important if you are trading a piece of real property, and that's all you're giving up, but in exchange you're receiving real property and a motorcycle. When you figure out your new basis, when you do your new basis calculation, that new basis represents your basis both for your real property, that like-kind property that you received, and the basis for the motorcycle. So you have to allocate the basis first to the non-qualified property, the motorcycle, and then anything left over goes to the like-kind property. And the purpose of all of this is to take that realized gain that you didn't have to recognize, and you preserve that realized gain that was unrecognized, so that unrecognized gain, and in your basis on the new property, right? So if I had an old basis of $30 and a fair market value of $100, and I exchanged it for a property worth $80 and $20 of cash, at the end of the day, I have two things. I have two pieces of property. I have an $80 piece of property, and I have a $20 worth of cash. And cash is property. So if my old basis was $30, I have to take that and divide it between the cash that I received and the property that I received. And so that's why we always subtract out the cash first, because the cash always has to have a basis equal to its fair market value. So first you subtract out the cash and you give it a basis equal to its fair market value, and then you put it in your pocket. And then you see what you have left. So here all I have left is $10, right? $10 of adjusted basis, $10 of protected money that's I've already paid or not had to pay, or not had to include in my gross income. Right? And so then my new property just has an adjusted basis of 10,000. So that's what our goal is with these non-recognition transactions, with 1031 at least, and with 1033. 1033 is a little bit more generous because we've got the involuntarily converted property. With 121, it's an exclusion of gain. Right? We're between that 101 and 140, and we know when we're between 101 and 140 with a code section, we're talking about monies that are excluded from gross income. So now it's not a non-recognition transaction, it's not where we're preserving that gain in the basis of the new property. In 121, we're excluding the gain. We're never going to recognize it. It disappears into thin air, right? Blah, blah, blah. What else about 121? So with 1031 and 1033, you have to replace the property. 1031, it's an exchange, you have to be receiving like-kind property. 1033, you have to replace the property within 2 years, right? 121, there's no requirement to replace the property. So when you looked in your book and you read all about the old law, which is getting older every year, right? It's more and more historic. So it's included in your book because you might run into people that were under the old law. A lot of the older practitioners know about the old law and were comfortable with the old law. It's less and less relevant going forward because there's fewer and fewer people every year that would fall under it, or have done any of those calculations in the past. So the old law did require a purchase of new property, but the new law, the new 121, the current 121, that's been in place for quite a while now, it doesn't require that you buy a new house. You sell your house, your personal residence, you sell it and you exclude $250,000 worth of gain, and you can go on a cruise or buy a lot of chocolate. It doesn't matter what you do with the money. So that covers non-recognition transactions, looking at 1031, 1033, and 121. 121, again, not really being non-recognition, more exclusion from gross income, totally exclusion from gross income. But they include it in this area because it's still, like a piece of property, I guess, that you're moving forward with. So this is definitely on the exam. There's a question on this on the exam, but I won't test liabilities. So you're only looking at a 1031, A, B, or C transaction, and then calculating basis under D. It's probably not a 1031A, right? It's probably not solely for property of like kind. We'll probably have like a B or a C type transaction. So just move through your worksheet up to the point of liabilities, and you'll be fine. And I'll take a portion of class where I'll answer any questions on non-recognition. And you're welcome to play this as many times as you'd like. So I hope you enjoyed it. And I'll hope to see you soon. Thanks a lot.